Well, hello, everybody. Steven Sitkowski here. Welcome to this week's edition of my Market Insights. Talk about what's going on in the financial environment. Market opened today down significantly. It looked like it was a potential for a meltdown, but market has started to recover. We're going to talk about why and a whole bunch of other things. Hope you had a great weekend's a little gloomy here up in the mountains, but we got 11, 12 inches of snow in the ski resorts. So that is always welcome. Hope things are good where you are. Quick reminder that everything I do here is for educational purposes only. It is not intended as investment advice. So let's move in the market. Well, the Trump tariffs are going into effect. He's got a 25% tariff on Canada and Mexico, and then a 10% tariff on China. Interesting that, China is supposed to be the big bad wolf. We only went 10% on them. Maybe it's because they are the big bad wolf. And these tariffs are supposed to take place at different times. I understand on Mexico, we're trying to use it as a bargaining chip relative to controlling the border. So what exactly is the impact of tariffs? Well, it just means there's an artificial price increase. And one would think, oh, well, the countries will pay it. That's not necessarily true. And the reason why this is not good for Wall Street is because they recognize that these price increases ultimately get passed along, at least in part, to the consumer. And so the question is, let's take an automobile, whatever car you want to pick. Let's do a Land Rover, since I'm a Land Rover fan. And you instantly raise the price of Land Rovers by 10%. So that has two potential impacts. One, it's inflationary, right? You're charging more without producing any more supply. And number two, it's probably going to reduce demand. There's going to be fewer people wanting to pay the higher price. Why do we put items on sale? Because it increases demand. Well, then the reverse of that must be true. So Wall Street tries to process all of that. I still don't think we fully know how it's going to shake out, but it is not good news for the markets. Tech stocks opened 2% lower, actually. The NASDAQ at one point was down about 2.5%. Last time I checked, and of course this is recorded, so that's a moving target. It was down a little more than 1%, so the markets were off of their lows, which was nice. Bitcoin took a 3% hit. It was down, I'll give you latest and greatest. It was down into the mid 90s. Not that we spent a whole lot of time on Bitcoin here. It's recovered back up to 99. 10-year treasury down to 4.508. I'd love to see that below 4.5. That's kind of the next benchmark. That would be good for equities. And oil prices creep lower down to 72.14. So what to watch this week? Not a particularly big announcement week, especially compared to last week when we had the Fed come out and they held interest rates, and we're pretty neutral on what rates are going to do moving forward. But we do have ISM manufacturing number coming out, and in fact, that has been delivered, came out at 50.9. Anything above 50 is actually expansion. I don't remember the last time we were expansion for a couple of years, so that would be considered good news. We got some Fed speak today. On Tuesday, the JOLTS report comes out, initial job openings. Last month it was 8.1 million. We're expected 8.1 million. So we'll see how that works. A little more Fed speak. we get the ADP employment number. That'll be important. Job creation. Um, we don't have an estimate. Last month came in at 122,000. These are non-farm payroll jobs. And then the services ISM number comes out. And then on Thursday, as always, we have initial jobless claims, which surprisingly fell to 207,000. The resilience of this labor market is pretty amazing. Supposed to come in at 213,000. And on Friday, we get the unemployment report. That is supposed to come in at 4.1%, plus U.S. employment report, that's from ADP. That'll be coming out with new jobs, and we'll get an update on what's happening with wages. So year over year, we're expecting wages go from 3.9% increase to 3.7, which would be anti-inflationary. This is last week's heat map. Whole lot of volatility last week. You can see a lot of bright red. I mean, these are companies that took a 3% or more hit. Look at Microsoft was down 5% on their poor guidance. NVIDIA down a couple of percent. Broadcom way up. Alphabet way up. Meta way up. AbbVie. So kind of a mixed bag for the year. The one that I thought was most interesting was Microsoft. So the S&P is up 23% for the last year. Microsoft only up 3.46%. But I do covered calls on that. So I'm typically squeezing out about 1% a week on a stock that's basically going nowhere. The big winners, NVIDIA up 88%. Remember when that was up over 200%? All things run in cycles, my friend. And the sooner you learn that nothing goes straight up or typically straight down, there's more of a chance straight down than straight up, because the stock can crash to zero. But Broadcom is at 85%. Tesla, 104. So Tesla over the last year is now up more than NVIDIA. Very interesting. Amazon, 51%. Alphabet 43, Meta 77, Walmart, Costco have both done great. Walmart up 78%, Costco 42%. I've done covered calls on both of those. So market sentiment has backed off just a little bit. It's gone from 43.4% bullish over the next 6 months down to 41%. This is a survey of independent investors. And how much is the Fed going to be cutting rates, and when? Next rate drop is anticipated to be in June. That is a very fluid situation. And as of now, not another one until January of 26. So as long as the economy remains strong, the labor market resilient, there's really no reason for the Fed to cut rates. So in the absence of rate cuts, what is going to be the big stimulus for the economy? It's going to be earnings. Companies are going to have to make money. 1 year sector return. So the S&P is up for the last 12 months, 19.58%. The big winners: communications, financials, discretionary, utilities. Technology is now just an average performer against the S&P. Industrials, and then we get a big drop off. Staples, real estate, materials, energy, and healthcare. So knowing which sectors are moving higher, that's where you want to be placing your investment capital. Let's take a look at the charts. As I mentioned, we've had a bit of a comeback. So we'll start with the SPX. So we are sitting right on that 50-day moving average. So we're at kind of another inflection point. but it has met the challenge every time we've been there. So that yellow line is the 50-day, and we're trying to crawl back up above it. If you wanted to look at sort of the price action so far today, see how the market opened lower? That was all tariff news, and it has clawed back some. What about the Qs? Sure, that's a similar looking chart. You bet. And what do the Qs look like for the last 6 months? Again, we're sitting right on that 50-day moving average. So, you know, our approach to the market has proven really successful. Our track record for last year on more than 100 closed trades, average return was 15.8%. That's not for the year. That's for 17.3 days. That's darn near 1% per day. So you definitely want to be paying attention, want to be learning your strategies. If you have any questions, by the way, let me give you an email where you could submit those if you want to find out about upcoming free workshops that I do. If you want to find out how to be a subscriber to the Trade Ideas of the Week that produce this track record, that would simply be team@marketmasterygroup.com. Team@marketmasterygroup.com. All right, I will see you next week. Until then, be safe, be blessed, and bye for now.